Hi all, welcome to i-tutor Academy. In today's session, we will start with the Unit 13, that is Pricing Strategies of MMPC 010. So objectives of this unit are understand different pricing strategies adopted by firms, identify the relevance of these pricing strategy under different conditions, apply pricing decisions to world situations, and structures are introduction, concentration ratios, and Herfinda index and constable market, price discrimination, peak load pricing, bundling, two-part tariff, pricing of joint product, transfer pricing, other pricing practices, summary, keyword section, and self-assessment questions. So these are the structure of this unit. So let's begin with the introduction part. So not every customer is willing to pay the same price for the same product. So how is is a seller to set price to maximize business? The answer is world of price discrimination. So a good example is price discrimination is different price charged for movie, concert tickets from students and adults. So you cab company is a American company which offers cab service across the world, even in India. So, price discrimination is one of the major strategies they have been followed for a while now. So, pricing for a same distance journey is different for different customers depending on their geographical location. The question, how should a product be priced, is of enormous importance to business, and most companies allocate substantial budget to market research both before launching a new product and one launched through the different stages of the product's life cycle. And economists argue that the level of demand for a product at any price is the sum of what all individual consumers in the market would be willing to purchase. This demand or willing to pay for any product is affected by three key factors. One is individual consumers' preference for the different characteristics of the product, price of close substitute to the product, and the price of good that must be used in conjunction with and the level of each individual consumer's income. So this will apply to any product, be it can of soft drink, automobile, or laptop. So this unit will examine the common pricing strategies adopted by firms, including price discrimination. And next is concentration ratio, Herfindt and Herfinta Hill index, and the contestable markets. The degree by which an industry is dominated by a few large firms is measured by concentration ratios. So these give the percentage of total industry sales of 4, 8, or 12 largest firm in the industry. An industry in which the 4 firm concentration ratio is close to 100 is clearly oligopolistic, and industries where this ratio is higher than 50 or 60% are likely to be oligopolistic. The 4 firm concentration ratio for most manufacturing industries in the United States is between 20 and 80%. And another method of estimating the degree of concentration is an industry is the Herfindahl index, that is its H is represent this, and this is given by the sum of the square value of the market share of all the fame in the industry. The higher the Herfindahl index, the greater is the degree of concentration in the industry. Example also here, and please read this so you will get more idea. And in fact, according to the theory of constantable market development during the 1980s, even if an industry has a single fame, that is monopoly, or only a few fame, that is oligopoly, it will still operate as if were perfectly competitive if entry is absolutely free and if exit is entirely costless. And an example of this might be an airline that establishes a service between two cities already served by other airline. If the new entrant faced the same costs as existing airlines and could subsequently leave the market by simply reassigning its planes to other routes without incurring any loss of capital. And when entry is absolutely free and exist is entirely costless, the market is constantable. And fame will then operate as if they were perfectly competitive and sell set at a price which only covers their average cost, even if there is only one fame or a few of them in the market. And next is price discrimination. In economic jargon, price discrimination is usually termed monopoly price discrimination. This label is appropriate because price discrimination cannot happen in a perfectly competitive industry in equilibrium. And monopoly power must be present in a market for a price discrimination to exist. And this seems a travel point when you understand the definition of price discrimination. The practice of charging different prices to various consumers for a given product in a competitive market. Consumers would simply buy from the cheapest seller, and producers would sell to the highest bidders, and the would be that. So with monopoly power, however, the opportunity may exist for same offer different terms, and uh, to different purchase, thus dividing the market, a practice known as market segmentation. Price discrimination refers to the situation where a monopoly firm charges different price for exactly the same product, and the monopoly firm uh, it can discriminate between different buyers by charging them different prices because it has the power to control price by changing its output, and the buyers of its product have no choice but to buy from it as the product has no close substitutes. And there are three type of price discrimination: first degree price discrimination, second degree price discrimination, and third degree price discrimination. The first degree price discrimination refers to a situation where the monopolist charges a different price for different units of output according to the willingness to pay of the consumer. An example: a doctor who is the only super specialist in the town may charge different fee for conducting surgery from different patients based on their ability to pay. And second degree price discrimination refers to a situation where the monopolist charges different prices for different set of unit of the same product. Example, please read this. And third degree price discrimination also here, when the monopolist firm divided the market in two or more markets and charges different price in each market, is known as third degree price. And airline tickets are common example of this form of price discrimination. Example, lower rates are applicable to senior citizen than business travelers. Electricity rates applicable to residential users are lower than those applied to commercial establishment, and so. And first degree price discrimination, monopolists engage in price discrimination when they can increase their profit by doing so. So even if seller know the maximum amount that different customers are willing to pay, developing a pricing scheme that makes each customer pay that amount, a practice known as first degree price discrimination, can be difficult. And under first degree price discrimination, the full benefit from the trade between buyer and seller accrues to the seller. And one strategy to achieve first degree price discrimination is to sell to the highest bidder through sealed bid auction. And the auction approach is best suited for situation where the volume of sales are low, and where there are many potential buyers who are unable to cooperate among themselves, and where buyers all have access to the same information about the product's characteristics. And the auction approach would enable to sell to identify those buyers with the highest willing to pay, and would yield the highest possible revenue for the same production cost. This is a common strategy for the sale of very special type of products such as art objects, antique furnitures, or the right to the mining and exploration of plots of land. And it is not suitable for most bulk producers produced products such as cans of soft drink or computers. And perfect or first degree price discrimination can occur when a firm knows the maximum price the individual is willing to pay for each successive unit. The firm could then charge that highest price for each successive unit and capture the entire consumer surplus. Remember that all forms of price discrimination involve some monopoly power, and but perfect price discrimination involves a degree of monopoly power rarely found in real world. And next is second degree price discrimination, where the auction approach is not feasible. The company must do its best to approximate the first degree outcome using its pricing structure. This is based on the notion that an individual consumer derives diminishing satisfaction from each successive unit of any product consumed. This form of price discrimination, which is based on the volume of consumer purchase, is very common and is known as second degree price discrimination. And other forms of second degree price discrimination include two-tier tariff and the price where the consumer must pay a flat fee for access and then a separate fee for usage. This is typical of many club and amusement park and transport facilities offering monthly or annual passes. And the ideal in the case of travel pass, for example, is that the traveler who travel infrequently pay on average a higher price per trip because the fixed access cost is spread over fewer trips. Okay. And second degree price discrimination is also referred to as multi-part pricing, and it is a block or step type of pricing in which the first set of unit is sold at one price, a second set or at a lower price, a third set at a still lower price, and so on. And note that this is different from a quantity discount in which the lower price applies to all unit purchase. And in second degree price discrimination, the lower price applies only to unit purchase in that block. The buyer must have already paid the higher price for the earlier units. Some familiar examples are here. Please use your IGNOU study material and read it out. Okay, so these are the example. And now let's look at the second degree price discrimination in a more formal graphic model. Okay, in figure 13.1, the seller faced the demand curve D of one typical consumer. And so this is second degree price discrimination. So this is demand and quantity is here and price is here. Okay, so in this example of second degree price discrimination or multi-part pricing, the first block of unit is sold at the price P1 and the second block is sold at the price P2. So this allows the seller to capture that part of the consumer surplus represented by the area P1, BC, P2. Okay. So next one is third degree price discrimination. So pricing based on what type of consumer is doing the purchasing rather than the volume of purchase is an approach known as third degree price discrimination. This is very common in the sales of air and rail travel, movie tickets and other products where consumers can be segmented into different group and who are likely to differ greatly in their willingness to pay based on certain easily identified attributes. So the third degree price discrimination or market segmentation required that the seller be able to segment or separate the market so that goods sold in one market cannot be resold by the buyers in another, and identify the distinct demand curve with the different price elasticities for each market segment. And students are one of the main beneficiaries of third degree price discrimination schemes, and since their demand is more sensitive than the population at large, and other often identified groups include senior citizen and the young, both of whom also tended to be more price sensitive, and the business purchase who are often less price sensitive and may be willing to pay a lot for small quality improvement. Suppose example, there are only two type of travelers, students and businessmen, and students pay for their travel out of their own pocket while businessmen charge their travel to their employees who in turn deduct these expenses from their taxable income. And since a typical student is likely to be willing to pay less for a travel ticket, all else being equal than a typical business, it makes sense for the company selling travel services to price higher to the businessman and lower to the tourist to get the largest possible volume of business out of each customer group. And pricing scheme can be quite complex and may combine element of second and third degree price discrimination. And example is the discount travel passes for students and pensioners, and in any case the main danger to the seller is that customer have an incentive to get together and to trade among themselves to benefit from existing price differentials. And thus, a student may try to purchase a ticket or he does not plan to use for the express purpose of selling it to business travelers and sharing the difference between the price, or a holder of a travel pass may offer the pass to a friend to use and enable the friend to benefit from the high volume of the holder's travel. And if this were allowed to happen, the seller would lose the business of the high price paying customer and would be better off offering a single profit maximizing price. And that is why the price discrimination is only possible in imperfectly competitive market where direct competition by rivals is made difficult by entry barriers such as established brand names like laptop magazines and differential products, scale economies in production, air and rail travel, technology, patents, pharmaceuticals, for where access to key input is limited, finance. So activity is here based on this subsection. Please try to do it, it will help you, and in between any doubts you can contact us anytime. And next subsection we will discuss on next video. And for more MBA series, you just do like, share and subscribe our channel. Thank you so much.
i-tutor Academy presents IGNOU MBA Complete Syllabus Coverage Classes for individual students, semester-wise subject with online flexible timing. For more details, contact on +91 623 827 1885.